Hi everyone. So we had a bit of a technical glitch earlier. So I'm here now. So I hope you can all see me. Let me just inform the people on the other window that I'm actually here. Just a second. Um, Sending them a message now. Okay, so we're live. So basically, before I get started, let me just say a few things. So first of all, I was going to do this webinar actually on a software. I sent out the software to a number of people, and about 20 or 30 actually signed up. However, many of them gave me the feedback that they couldn't be sure whether they could make this webinar or video live stream sessions, which I've put it on now. That's basically the reason why I've actually done it this way. And this is my first time on YouTube Live, as you can probably tell. So I had to actually use the Chrome video in the end, which says something. I've said on many videos before that production comes before perfection. In other words, many people, whether it comes to expat investing or whether it comes to business or any area, they're so focused on getting everything perfect that they actually forget that getting something out there at 80% is better than waiting 6 months to do something perfectly. Almost every single person I know who is focused on perfection ends up basically never doing it. So for example, I have many friends who always say to me, oh, Adam, I'm going to invest, or Adam, I'm going to write a book, or whatever they're going to do. But because they're perfectionists, they actually never get it done. So I think this is actually a very good example of how focusing on perfection is never actually a good idea. So let's start with the introduction now. So first of all, the way I'm going to structure this is I'm going to answer some frequently asked questions. And in addition to that, I'm going to talk about the biggest mistakes that I've seen. And also, I've gotten about 4 or 5 questions from people who signed up to this webinar, some of whom can't make it today. However, I agreed to answer those questions on the YouTube Live because hopefully this video will go up as a saved video after the event. So let's get going now. So first of all, let's talk about some of the biggest mistakes that I've seen expats make. So number one is what I would call home country bias, and this can lead to lower investment returns. And in addition to lower investment returns, it can actually lead to tax problems. Now, what do I mean by that? As many of you have probably gathered, there's more and more digital nomads in the world now. So more and more expats don't exactly have a fixed base. So many countries around the world, like Australia, for example, a court in Australia ruled that one gentleman, even though he hadn't lived in Australia for 10 years, because he actually was receiving post to his Australian address, and in addition to that, he was sometimes going home, they actually told him to prove that he was really an expat. In other words, what's happening now is many countries around the world are telling expats to prove that they are non-residents, right? So many people, what they're doing is they're sending money home, but not only can this sometimes lead to tax disadvantage structures, but actually in addition to that, many tax authorities in numerous countries have asked people to prove where they're resident. And then in addition to that, this causes another problem. If you're an expat, so let's take the UK as an example where I'm from, and you are earning in pounds and you plan to live in the UK again when you retire, currency fluctuations don't make a difference. But let's face it, if you've been an expat for 20 or 30 years and you're planning to retire outside of the UK, having US dollar-based investments makes sense. There's so many British people I've seen, not just British, Australian, Indian, whatever, they're just focused on their home market. So if something happens like in the last 10 years in the UK, where the UK currency, and in addition to the UK currency going down, actually the stock markets haven't performed as well as the US counterparts. Think about it, right? UK investors with so-called home country bias have actually done worse than almost any other investors. But it's not just the UK, right? There's many countries recently, emerging market currencies that have had absolutely huge falls. So I would say no matter where you're from in the world, as an expat, having a US dollar-based account can sometimes make sense. Don't only focus on your home country's currency, and indeed, your home country's stock market, your home country's real estate market. Psychologists call this familiarity bias. In other words, we invest in things we're only familiar with, like Indian investors invest in gold, British investors want to invest in British property or whatever. Avoid familiarity bias. It's a part of human nature, but sometimes you have to overcome human nature. That's the first thing I would say. Now, in addition to that, I would also avoid having a bias towards your country of residence. Now, what do I mean by that? I've lived in developed countries like Japan. I've lived in underdeveloped countries. I've lived in mid-income countries. But what do I always find? On day one, let's say Cambodia as an example. I've never met an expat who on day one comes in and says, you know what, I want to buy Cambodian real estate. I've never once heard an expat in Cambodia say that. I lived in Cambodia for 1 year, by the way. However, over time, after they start going to dinner parties and they hear about other expats making a lot of money in real estate in Cambodia, they start to think, wow, this is such an easy win. But if you think about it, if investing in Cambodian real estate, as an example, or Indonesian real estate, or Rwandan real estate, or whatever, was such an obvious answer, why isn't Warren Buffett or Soros or all the institutional investors, why aren't they getting involved? In other words, remember, all of the information about investing is publicly available. You or I, no matter how much research we do, we are not going to have that secret knowledge. We could be sitting here in New York or London, Chicago, whatever. All the information about, say, for example, Cambodian real estate, Indonesian real estate, Indonesian stock markets, US stock markets, it's all available now on your fingertips. The idea that just because you're in a country, that means you have to invest in that country's real estate or stock market is nonsense. But again, this is where familiarity bias comes into play. In other words, many investors, they either make the mistake, it's a two-pronged attack, right? Let's say where they come from and their country of residence, right? And with these two things, they are two sides of the same coin. They're two sides of the familiarity bias coin. If you only invest in your home country stock market or real estate, or you only invest in the country you're in, that's two sides of the same coin. It's familiarity bias. So I've seen so many expats living in Dubai, they think, well, buy Dubai real estate. Oh, and by the way, let's invest in my home country. I'm not saying you should never do this, but never think just because something's familiar, because you live in that country or indeed you're from that country, you should always focus on that. So that's the first mistake, is familiarity bias. Now, the second mistake is what I would call keeping up with the Joneses. Now, this is the same all around the world, but I would say it's a bigger issue in expat markets. Now, why is that the case? Think about it, right? If you're in your home country, unless you're in the capital city, like for example, the UK, right, where I'm from, apart from London, there isn't really a showing off culture. Okay, Instagram has changed that or whatever, but in general, we don't show off. But now let's say you're in Singapore or Dubai or Shanghai, a place where there's a lot of wealthy locals and expats, like the top range, the top people are making loads of money or they're showing off. So I've met so many expats who are on huge packages or indeed small packages, but you know what? They always find a way to spend the money. So this is a thing, especially if you're in like a materialistic market, always avoid that obvious thing of keeping up with the Joneses. Now, the third mistake to avoid is timing markets. Now, that's not an expat specific thing, but many expats, they think they can time markets just like non-expats. Obviously, avoid that. Never time markets, never speculate, and so on. Also, I would say another key thing for expats is this. You're moving from country to country, right? The days of the career expat are probably over. Don't get me wrong, there are some people who spend 30 years, 40 years in one country. But let's face it, a lot of people, they could spend 3 years in Dubai, then 3 years in Singapore, then they could go back home, then they could spend 2 years in Amsterdam. And even if you didn't think you were going to, look at Brexit, that's moved so many people to different parts of the world because of what's happening with London. So ideally, you want an investment solution that can follow you no matter where you go. You don't want a situation where you're getting an email from your investment broker saying, well, look, you've now moved to Singapore. We're not regulated in Singapore. We can't take you because of laws. Ideally, you want an investment platform which can follow you everywhere or within reason. So a lot of the investment platforms I deal with, or some other advisors deal with, they can basically take people anywhere apart from the United States, because the United States is a completely different legal situation to many countries. And that leads me on to basically the options you have as an expat. So what are the main options that expat investors have? Of course, you've got the things I already talked about, property, also putting money in the bank, which are not always great options for fairly obvious reasons. But then assuming investing is actually, you're talking about investing in the financial markets, you essentially have two main options. You have lump sum investing and you have regular savings, right? However, one of the biggest mistakes I've seen expats make is they will focus on some of the more expensive familiar brands. So some of those huge banks or insurance companies, they charge a lot of money, right? If you go to, I shouldn't probably name names, but if you go to some of the biggest banks in the world, they have a brand reputation, right? So people feel familiar. We're getting back to that word familiar again. People feel familiar, they feel reassured by the big names, so they are willing to pay 2%, 3% per year. Same with some of the biggest insurance companies in the world. So one of the key mistakes expats make is signing up for expensive products, but the reason they sign up for those expensive products is the brand name sounds reassuring and makes them feel safe. So my strong suggestion would be expats should focus on the lower cost area of investing. That means online investing. It means using platforms which are much cheaper than some of the more traditional options. However, typically speaking, if you have a lump sum, more options are available to you. Think about it, right? If you have $500,000, of course, more advisors and more platforms are going to take you than if you only have $500 a month or $200 a month or $1,000 a month. So I will share some resources with you, but what I would say is from the two options, lump sums is usually a little bit cheaper and more options, but there are some of those newer providers in the market which charge a lot less than those kind of more traditional providers that you might be aware of. Now, beyond that, you also have the option of putting your money in the bank in emerging markets. I was watching a video of a well-known YouTuber, and he was basically advocating that many expats should consider putting their money in emerging market banks because they give you 6%, 8%, 9% per year. I would say this, though, as a word of warning. Needless to say, if you're going to put your money in the bank in, say, Georgia or Cambodia or whatever, most of the time, either the high interest rates are linked to the local currency, or indeed they are US dollar backed sometimes for a bit less. But bear in mind, if there's a financial crisis, the Georgian government, the Cambodian government, they're probably not going to be able to stand behind the banking system. So if you've got money in the bank in the US or in Europe, you're not going to get paid very much, but at least your money is back to a certain extent. That doesn't mean you should keep loads of money in the bank. But my strong suggestion should be that you should keep money in markets. Cash should be used as cash, property should be used as a home, and markets for an investment. And one of the biggest reasons for that is this. The historic return on, say, the S&P 500 is about 10% a year, which is 6.5% after inflation. Now, don't get me wrong, there's some years it's going crazy, it's going at 20%, some years it's going down. But if you're prepared just to buy and hold numerous indexes, you're prepared to be a long-term investor, almost for sure you're going to make more money than 4 or 5%, 6%. So if you put your money in an emerging market bank, even if nothing goes wrong, yes, you're making more money than you would putting your money in the bank in the UK or the US, but longer term, you're not going to make as much money as actually investing your money. And if you think about it, right, why can the banks offer those good exchange rates? Because they're using their money to fund, more profitable projects, right? They're using depositors' money to go and make investments themselves. So if it was such a good deal, why would they offer, depositors so much money? So I would also avoid that. Also, beyond that, one thing I would say is I would avoid ever being short-term in markets as a final mistake. Now, the chances of you losing money, so let's take the S&P or MSCI World as an example. If you invest for just 1 year, you've got, historically speaking, 72% chance of being up or something like that, 28% chance of being down. However, if you do it for 10 years, you've got about a 10% chance of being down and a 90% chance of being up. If you do it for 25 years, it's never happened historically where an investor has lost money over 25 years. That doesn't mean it can never happen again, right? Let's face it, in recent years, we've seen in politics, right? People say, oh, Trump could never get elected. It's never happened before where somebody who's got no political experience has been elected, and so on. There's always a first for everything. But bear in mind, historically speaking, markets regularly go down, but when it comes to long-term investors, a long-term investor who has invested in some of the key indexes, has never been down. So if you just invest for your whole lifetime as an expat, 25, 30, 35 years, and you're in some bond funds or in some index funds, the chance of you being down is very low, provided you don't panic. There's so many people say things like, well, you know what, I want to invest for 5 years because I'm saving for a property, or I'm saving for a wedding. That's fine, but it's much higher risk than just buying and holding. Okay, everyone, well, I've got some questions here which some people asked me, the people who signed up for the webinar, some of whom can't be here, but they are going to watch it later on. And they're basically asking me expat specific questions. Now, the first question is very easy to answer. They said, can UK expats invest in ISAs? The easy answer to that is no. I do know some UK expats who haven't informed their broker that they're moving overseas and they continue to invest in that tax-efficient structure. But lying is never a good idea, right? So the easy answer is no. Now, a second question is about American expats. Should they ever invest overseas? Now, as many American taxpayers know, the tax situation for Americans has become much more difficult now because of the IRS and so on. What I would say is you should either go with an American broker or you should go with an expat broker who can help you file, US taxes. Because Americans are the one nationality, for sure, that don't always benefit from an offshore structure, because the American government essentially doesn't want expats investing offshore. Now, another question I've got is property as a non-resident. A lot of people have asked me questions before this seminar saying, oh, I'm British, can I invest in X and Y property market, or can I invest back home, or I'm Indian, can I invest back in India? Now, obviously, rules change all the time, and rules change country to country. And in addition to that, different lenders have their rules. So, for example, in the UK, it used to be very easy to get expat mortgages, but now only a few providers are still in the market. However, as a generalization, I would say you can usually invest in property in your home country or beyond as a non-resident, although it depends on the country. Like New Zealand has recently banned foreign buyers from most property markets. But you usually can't get a bigger mortgage. In other words, let's say if a provider will give you a mortgage and they give local people 95%, 90% mortgage or 85% or whatever, they might give an expat an 80% mortgage or 75% mortgage. In other words, you'll have to put down more money because you're considered a bigger risk because you are investing outside of your home country. You're probably paid in a different currency. Another question I got here from Jill was about if you have a business overseas, can you rely on a business as a pension? What I would say in general is liquid assets like property or business, you can never know when you'll be able to sell those, right? God forbid, let's say if you got a heart attack tomorrow, how easy will you be able to sell your business? I've heard so many people say, well, my business is going crazy well, I'm making 20%, 30% a year. Why should I invest in something that will pay me 10%? Well, you never know what's going to happen to your health, number one, and number two, how liquid is your money in a home or indeed a business, right? That's a key thing. Okay, everyone. Well, this is a first time on YouTube Live for me, so it's a good, starting point as an experiment with you guys, and this is going to be left up, I'm sure, for the next few months. So those of you who want to ask me questions on a private capacity, I'm going to also put my email below. Because I know a lot of my people a lot of my followers, should I say, who are living in America or other places, the time zone hasn't been great. So a lot of people are going to be watching this subsequently. So I'm going to leave my contact details below. And if you have any questions, let me know. And I think in future, I'm going to make some changes. So if I do YouTube Live again, I'm going to have more notice. I'm going to probably put it at a slightly different time zone. But I think this has been a good experiment from the point of view of seeing how the software works. So I hope you have a good day, and we'll speak soon.